Business owners who want to maximise their outcomes when selling their businesses need to understand the motivations of prospective buyers and the dynamics of the markets in which they operate. The best outcomes are usually from strategic buyers. Those who will pay the most are usually those with the most to gain and the least to risk. We've divided the buyers into 5 categories, which we're discussing in this and other videos. They are the buyer job market buyers, private investors, private corporations, private equity funds, and publicly listed companies. In this video, we're looking at publicly listed companies as acquirers of businesses. They're represented by the blue line on this chart. The publicly listed company arena has industry consolidators in virtually every industry sector. These are strategic investors who are expanding through acquisition, usually in their core industry. Publicly listed companies operate with a different set of business dynamics to private companies. Typically in private companies, profit is the driver of growth and investment, and shareholder value is secondary consideration. In contrast, publicly listed companies focus on increasing their shareholder value. As with private companies, acquisition is the fastest growth mechanism for a public company. However, the benefit is multiplied several times. Not only does the acquired business bring its profit into the publicly listed company as the primary benefit, but there is a much greater secondary effect. The returns required by shareholders of public companies are usually much lower than those of the equivalent private companies. Rigorous reporting requirements, greater share liquidity, increased availability of investors, and access to them usually drives the price of shares much higher than for a private company with an equivalent profit. The capitalisation rate applicable to a business is also referred to as the price-earnings ratio, or PE ratio. PE ratios vary widely but could be in the range of say 10 to 20. This is on after-tax earnings, which is important to shareholders. Say the investor is or expects to be trading on the stock market at a PE of 18. That's price earnings ratio of after-tax income. Now this is based on NPAT, net profit after tax, and with a 30% tax rate would equate to an EBIT multiple, earnings before interest and tax, of 12 times. And now's the interesting part. This is how arbitrage works. Let's say a private equity investor or a listed company wants to buy a business that has an EBIT of $1 million, earnings before interest and tax. This is a private company with an EBIT of $1 million. Let's say they're prepared to pay 4 times EBIT, which is 25% return. So they'd be paying $4 million for a business making $1 million EBIT. So you can see that by buying a business that was making $1 million a year and paying $4 million for it, they now own the business and they're trading at 18 times PE, which is 12 times EBIT. So that business is now worth $12 million to the company who just bought it, having paid 4. So they've made 3 times their money just by simply making the acquisition of a private company at 4 times multiple. So their motivation with that kind of uplift can be quite different to that of a private company making a similar investment. But let's say that they haven't done so well in that business and the profit halves. They may have lost key staff, they just may not run it as well. In many cases they can increase the profit of businesses with their own leverage and synergies. But let's say in this case they've only halved the profit down to 500k. Now if you had bought that business as a private company, clearly you've halved your value. You've bought it for 4 and it's worth 2 on a 4 times basis. But the listed company is still trading at 12 times EBIT, which is 18 times PE. So that business is still worth 12 times the 500. It's still worth to the shareholders $6 million. And remember, they only paid $4 million for it. So you could buy a business making $1 million profit. The profit could halve to $500,000 and the shareholder value could still go up by 50% from 4 million to 6 million. Not a bad deal as a shareholder if that's what's driving you. So now, assuming that a publicly listed company can access substantial amounts of capital, which after all is one of the reasons for being public, it can dramatically increase their shareholder value simply by making acquisitions continuously. The profit of the business acquired doesn't have to increase. In fact, it can actually decrease. But the more acquisitions a publicly listed company can make of private companies, potentially the greater the acceleration in its shareholder value. So what happens is a publicly listed company makes acquisitions, its shareholder value accelerates quickly. The delighted shareholders continue to pour more money into the company in expectation of further acquisitions and further massive uplifts, driving the PE ratios even higher and fueling faster growth and higher returns. Publicly listed companies who aggressively make acquisitions under this model may need to continue making acquisitions to continue to meet shareholder expectations as they grow. So the shareholder expectations are growing, they're making more acquisitions to the point where the business becomes addicted to acquisitions. This can continue as long as the company can continue to raise capital and find acquisition targets, and sometimes they have to go offshore and find ever increasing size value businesses to acquire, and ultimately that could create a bubble. And I'm sure most listeners would be aware of many high-profile companies that have succumbed to that addiction. So it's important for business owners to understand that publicly listed companies can pay more for acquisitions than, say, private investors, but it doesn't mean that they will. And they are usually quite disciplined in their approach. They apply hurdle rates of return, and certainly will, if their target is just too expensive, they'll just move on to another one. But it does mean that they have the capacity to pay more if the business is a particular interest to them. In summary, publicly listed companies are generally industry consolidators making acquisitions. They expand through strategic acquisition. They have different business dynamics in terms of acquisitions to private companies. They focus on increasing shareholder value, not just the profit. They work on higher PE ratios, and the increased shareholder value versus the cost of a private company can be substantial. And even if the profit declines, they can still increase shareholder value. I hope you understand more about the dynamics of public companies making acquisitions of private companies, and this should help you if you are approached to sell your business to a public company. If you found this video useful, please give it a thumbs up and share it with colleagues. Bye for now.